Hello, good afternoon to all, and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Once again, good afternoon. Today will be Friday, the 7th of February 2025. So, as usual, before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future, or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So as usual, before we jump straight into today's intraday technical outlook, I'd like to share with you guys what has taken shape yesterday in terms of the intraday performance of the cross asset classes, relevant news flow, and as well as key data that has been released in today's early session as well. Okay, so let's start with the FX market yesterday first. So over here, the FX market, if you look at the 5-day rolling performance yesterday, is rather a mixed bag. So the FX market actually traded sideways yesterday in terms of the dollar against the major currency as of 7th of February. And despite the fact that the dollar initially it starts to strengthen against the sterling pound right after the Bank of England made that announcement. But however, the sterling pound managed to actually gain some ground after losing a fair bit on the intraday, where the sterling dollar managed to actually stage a rebound right above our short-term pivotal support level that we highlighted yesterday as well. And one of the reasons why initially the sterling pound actually lose much significant ground against the dollar yesterday. So initially, based on the 5-day rolling performance basis, yesterday it actually shed down close to negative 0.5%. I mean that the dollar actually gained strength, then thereafter it's tried to actually plateau downwards. Okay, pardon me. All right. So one of the reasons why the dollar gained against the sterling significantly yesterday, because of a rather we call it a stagflationary forecast based on its latest economic and inflation forecast as being portrayed by the Bank of England. So let me highlight to you guys what you see over here. So Bank of England cut rates as expected. So that is actually a 25 basis point cut. So no big surprise for the market. But what surprised the market, what actually causes a bit of a surprise is that there are actually two members urging for a 50%, 50 basis point cut instead. All right, that means instead of cutting 0.25, there's two outlier member opting for a 50 basis point cut. And previously, there was this Catherine Mann, who has been one of the panel, which is among the among the 9-member Monetary Policy Committee. She's actually the most hawkish voices, and right now she actually tilted her pendulum towards on the dovish side and is rather extreme, advocating for a half-point cut instead of a 25 basis point cut. But majority wins. Governor Belly and the others support a much smaller move of 25 basis point cut. But what's interesting over here is that if you will look at the projection of the latest growth projection for 2025, the pink one is projection being done in February yesterday that was released. The black one was in November last year. Okay, so if you look at the 2025 growth end of year growth forecast, initially November they projected it to be 1.5% for end of year 2025 GDP growth forecast for UK. But right now, yesterday's latest forecast for the month of February that was issued in February, pardon me, has a downgrade of to 0.8% annual GDP growth for 2025. And what's interesting for CPI, in 2025, they are looking at 3.5% for the end of 2025. But however, 2000 for the end of 2025, they are initially the earlier November projection penciled in at 2.75% for inflation, annual inflation growth forecast for 2025. But for yesterday's February latest projection, they upgraded it to 3.5% expected for the end of the year annual CPI data for the year end 2025. So what does it mean over here is that it means that Bank of England now is pretty much cautious about stagflationary risk, even though during the press conference, Bank of England governor didn't actually admit it. When the press quiz him, is it because of Trump's potential trade tariffs against its major trading partners? So even though we know that the global economy is interconnected, Trump himself do not explicitly say that he wants to target UK, but it could have a boomerang impact on the rest of the global economy because of these tit for tat measures between US and its major trading partners like China for sure, Mexico and Canada and even Eurozone. If Trump were to actually next to target Eurozone, which is pretty much likely given his rhetoric, hawkish, we call it statement on Eurozone being a what I call it a leash or towards the US economy. All right, so that actually causes the sterling dollar to lose much ground yesterday. But what's interesting over here is that if you look at the sterling dollar, later I'll share more details on the technical chart. This was the chart that we saw yesterday. Key support level, which is the 20-day moving average, where we expect an initial slide. But what's interesting is this slide on the sterling dollar managed to rebound right exactly at our short-term pivotal support level that we highlighted yesterday as well at 1.2375. All right, so later we'll touch on more about that when we touch on the short-term intraday technical outlook on the FX market. And another interesting market to look at over here will be the yen. So if you look at the dollar yen, right, the dollar yen continues to be yes, it's trading sideways, but it continues to be the weakest against the major currency. That means the dollar is the weakest against the yen among all other major currency. And one of the reason over here is due to improving consumer spending and wage growth potentially that may be that there may be another sizable wage growth hike by the end of March this year after the conclusion of their annual spring employee and employers wage growth annual wage growth annual wage negotiation. And today, right early Asia session, we have also see a positive sign of household spending increase way above expectation. So household spending has started to bump up significantly for the month of December. 2.7% year-on-year increase, way above what market is expecting at 0.2%, and also way above the negative growth year-on-year rate in November. So if you look at the household spending in Japan, so take it as something like a consumer spending in aggregate because it's like household. So if you look at this situation over here, there is a big reversal. I want to share the chart. Okay, so this is the 5-year chart. Okay, notice that there's this big bullish reversal breakout above the 0% growth level that previously was in April 2024 and July 2024. Very clearly, there's this breaking out of this bullish breakout from the previous descending trend line on the growth chart of the year-on-year growth chart of Japan household spending. So if this trajectory continues, it seems to be continuing in the last 2 months or so, and it gives further confidence of Bank of Japan to continue its slow pace of interest rate hike to bring potentially the short-term interest rate to between 0.75 to 1%. Right, because right now the Japan interest rate short-term policy rate is only 0.5%. So there could be another potential 2 more interest rate hike to go in Japan. So that also supports the yen strength against the dollar that we start to see in the last week stretching into this week as well as we are speaking. So later I'll touch on the intraday chart on the dollar yen because very interesting because we know that today there will be another key data coming up, which is the US non-farm payroll data, where market consensus is rather putting it as a very low ball number. We'll touch more about that when we cover the economic data series focus to watch on towards the end of today's day dose session. And another data to look at over here will be Amazon. So we know that Amazon is one of the mega cap one of the mega cap stocks in US that has a significant weightage on the Nasdaq 100 and the S&P 500. So what you see is that Amazon actually didn't give a very yes, the earnings beat. Okay, the Q4 earnings beat on the headlines on the bottom line, but however, it does not give a rather rosy guidance. It's saying that potentially can't keep up with AI demand over here. So he warned investors that there could be capacity constraint in its cloud computing division. All right, that means i.e. they are not able to fulfill customers requests in this instance. So with that, that actually causes Amazon stock to actually plummet to 4.4%, exactly 4%, upon the earnings announcement that was released at the close, after the close of the yesterday US session. So with this plummeting of 4% on Amazon, which is a mega cap component stock within the Nasdaq 100 and the S&P 500, it created a not so rosy situation right now as we are speaking, based on the E-mini futures on the S&P 500 and the E-mini futures on the Nasdaq 100. Both they are trading right now. They are actually down by a minor loss of negative 0.09%, and the Nasdaq 100 E-mini futures is down by negative 0.07%. All right. So with that, that actually sum up the first session of the daily dose. So now let us now focus our attention to the intraday technical outlook. Okay, that I'll share with you guys. So with that, let me expand my screen so that you guys could have a better view of the charts. So let's start with the European currency first, starting with the euro dollar. So the euro dollar yesterday also dipped down as expected after hitting our first resistance level that we highlighted yesterday, and this dip down managed to hold right exactly at our short-term pivotal support level. So we highlighted two support level to watch yesterday at 1.0365, followed by this 1.0345. And it did manage to did a slight minor recovery. All right, so still no change, still, because it did manage to break below 1.0345 short-term pivotal support level that we have for yesterday. So we still maintain that intraday bullish bias on the euro dollar, but except that we do have one shorter term resistance level to watch for today. Will be close to the 50-day moving average as well, now acting as the next near term resistance level at 1.405. Okay, 1.4050 here. Okay, 1.4 1 point. Okay, pardon me, this one. Give me a minute. Let me write it in proper writing. 1.0405. Okay, so 1.0405, first near-term resistance level to watch. Above it potentially sees expose the next near-term resistance zone of 1.0440 slash 1.0460, which is the minor swing high that has been met on this Wednesday and previously on last Friday as well. Okay, only a push down with an hourly close below 1.0345. Short-term pivotal support for today will invalidate today's intraday bullish bias on the euro dollar to kickstart another round of minor corrective decline sequence in the first step, exposing the next short-term support level at 1.0270 next. All right, so it's now kind of a make or break level for the euro dollar on the short term intraday basis, given that it managed to do a minor bullish reversal right above the 1.0345 short term pivotal support that we highlighted yesterday. Now, what's up next for the sterling dollar? So very similar for the sterling dollar as well. It also managed to did a minor bullish reversal right exactly at the 20-day moving average, which is our predefined support level that we have yesterday at 1.2375. So still no change, given that it managed to hold on to this support level. So it's also like a make or break day for the sterling dollar in order for the bullish bias to maintain after yesterday's minor bullish reversal. But we do have a much more tighter first resistance level to watch for today in order to surpass, to gain traction. Will be at 1.2460 slash 1.2490. Only a clear break above this 1.2460, 1.2490 potentially may expose the next near-term resistance zone at 1.2580, followed by 1.2610 next, which is the minor swing high area of 30th of December last year and 7th of January this year. Only a push down at the hourly close below 1.2375 for sure will invalidate today's intraday bullish bias to open up scope for a potential, we call it a short-term intraday weakness on the sterling dollar to revisit 1.2240 in the first step. right? So i.e. still using 1.2375 short-term pivotal support level on the sterling dollar in a potential make or break scenario for today in order for the bulls to maintain its intraday bullish bias. Right, so that's for the sterling dollar. Right up next, opposite will be the Asia Pacific currency. Let me start off with the Aussie dollar first. So the Aussie dollar is slightly different now. Yes, the Aussie dollar managed to rebound, but the momentum is rather weaker. So what I could see here is that it rebounded right exactly at our first resistance level, okay, which is the 50-day moving average at 62.95. And upon hitting this 62.95 in today's Asia session again, so there was a test of it during during the Wednesday New York session. Then thereafter, it traded downwards throughout yesterday's Asia session and right into the European session. And it managed to bounce during the US session yesterday, but can't break above 62.95. So upon doing this second retest at 62.95, which is also the downward sloping 50-day moving average, the hourly RSI has started to shape a clear bearish divergence. Okay, so very clearly, price action shows similar high, but the RSI is downward sloping. So indicating yesterday's push up to retest 62.95 comes with lackluster momentum. That means there's not strong momentum at all. So with that, we will still use 63.30 because that is our medium-term pivotal resistance level that we highlighted earlier. No points putting a push up towards 63.30. So yes, it may whipsaw a bit here today given the NFP data that may come in, but however, as long as it didn't surpass above 63.30 short-term pivotal resistance level, as long as it didn't surpass 63.30 short medium term pivotal resistance on the Aussie dollar, we still do have a mild bullish bias on the Aussie dollar, but it got to surpass the first near term support level at 62.40/62.25, right? Because this is being a very clear near term support zone that managed to held up the Aussie dollar since breaking up above it on the 5th of February, which is this Wednesday, and also correspond closely to the 20-day moving average, acting as this near-term support level as well. So roughly put it in a nutshell, as long as 63.30 medium-term pivotal resistance is not surpassed, there could be a test of it again today because of the non-farm payroll data high volatility event. Potentially, you may see this kind of two-way volatility swing. Still maintain that mild bearish bias on the Aussie dollar, but first near-term support level to watch only for today will be at 62.40/62.25. Unless we have a clear break below 62.25, then potentially we may expose more potential intraday weakness for the Aussie dollar to revisit 61.65 next. Only an hourly push up and a close above 63.30 potentially sees a further squeeze up towards 64 figure level. Right, so that's for the Aussie dollar. Now, on next with the dollar yen. So dollar is very interesting. So yesterday we do have a intraday bullish bias to look out for that minor mean reversion rebound holding above 51.90. So 51.90 was yesterday our short-term pivotal support level. Price action indeed bounced and hit our resistance zone at 152.90/153.25. Also the 200-day moving average during the European session at 5 p.m. mark. Then thereafter, it traded all the way down and hit our next support level where we highlighted after 151.90 is 150.95/70. Right, it print a series of lower low during today's Asia session as well after that report of that rather rosy Japan household spending in today's early Asia session. So upon hitting the lower low, the price action on the hourly RSI continued to shape that bullish divergence. Very clearly lower low in price action, but does not match with the movement of the RSI. It starts to slope upwards. So what it means that over here is that this push down in terms of today's momentum, bearish momentum may have started to ease off. So what I'm going to do over here is that for today, since it already hit our support level after 151.90, I'll be using this support level here, which is a graphical level and a one-time Fibo extension. Okay, this graphical level over here. Okay, this congestion area of 5th of December and 9th of December, as well as 10th of December last year. So using 150.95/70. So this will be my short-term pivotal support level, we do potentially have another potential mean reversion rebound scenario that could take shape for today. So we do have a IE maintaining that intraday bullish bias for that potential another round of mean reversion rebound scenario on the minor scale. We in this medium term downtrend that is still intact as price action continue to trade below the 20 and the 50-day moving average. But first resistance you got to surpass will be 15190. Only a breakout above 15190 potentially exposes 15290 again slash 15335. 15325 next. Only an hourly close with a push down below 15070 invalidate today's second round of potential mean reversion rebound scenario to kickstart another down impulsive downward sequence to expose the next near-term support level at 14970/30 level, and potentially if this level doesn't hold at 14930, it will expose 14880 next, which is the 1.38 Fibo extension, and very clearly this medium-term swing low area of 3rd of December that previously managed to kickstart a rather significant V-shaped recovery. That so, i.e., in a nutshell, still maintaining that second round of potential minor mean reversion rebound scenario as long as 1595, 15090, 15070 short-term pivotal support holds on the dollar yen for today. All right, so that sum up the intraday technical outlook, key levels to watch on the FX market. Now, turning our attention now will be the major stock indices, starting with the Hong Kong 33, i.e. representing the Hang Seng Index. So the Hang Seng Index finally managed to surpass above last this Tuesday minor swing high at 20,980, and right now almost hit our resistance level at 21,320/21,390. RSI is overbought right now, but doesn't shape any bearish divergence as it continues to inch to hit a higher high in line with the price action that's being depicted right now on the raw price action on the Hong Kong 33. So with that, we'll have a rather tight short-term pivotal support level for today, taking into account of today's Asia session low, which is at 20,800. So as long as any minor pullback that could take shape right now, because we know that only about 3 more hours more to go before the cash market of the Hong Kong stock market closes. Then thereafter, the futures will start to open during the European session. So there could be a minor pullback taking shape during the European session, given that the hourly RS is overbought. As long as this minor pullback didn't surpass below 20,800 short-term pivotal support level, a tighter one thereafter, we'll still maintain that intraday bullish bias on the Hong Kong 33. Above 21,390 potentially sees 21,710/21,800 next. Only a hourly close below 20,800 and the breakdown below it invalidate or negate today's intraday bullish bias to kickstart a much more deeper minor pullback scenario sequence, exposing the next support level at 20,470, maximum 20,170, which correspond to the lower limit of this minor ascending channel that is in place since 13th of January. So i.e. in a nutshell, RSI is being overbought right now. There could be a chance of a minor pullback taking shape, given that the Hong Kong cash market session is about 3 more hours, but less than 3 hours more to go before it closes. Using 20,800 for that short-term pivotal support level to watch out for any chance of a rebound thereafter during the futures market open for the Hang Seng Index. So i.e. still maintaining that intraday bullish bias on the Hong Kong 33 that is representing the Hang Seng Index with a tightened key short-term pivotal support level at 20,800. Onward next will be the Japan 225 representing the Nikkei 225. So still no change, it continues to remain sideways, and right now it's about to hit our first support level at 38,680, which is the 200-day moving average as being defined by yesterday. So no change in terms of key levels as it continues to be trapped within a minor range, within a medium-term complex sideways range configuration that is in place since the low of 7 September 2024. All right, it's been trapped in this kind of complex sideways range configuration. So right now it's something like a minor sideways range configuration within a bigger medium-term sideways range configuration. So still using 39,310 as my short-term pivotal resistance level, which is the upper limit of this minor range configuration that is in place since 4th of February. That means this Tuesday, after it can't break above the 20-day and the 50-day moving average. And a breakdown below 38,680 potentially sees the lower limit of this minor range configuration coming in at 38,410 slash 38,140, which is the minor swing low of 13th of January and 17th of January. Still maintaining that intraday bullish bias, intraday bearish bias, pardon me, still maintaining that intraday bearish bias on the Japan 225 within its minor range configuration using 39,310 as my short-term pivotal resistance level. Only an hourly close above 39,310, a breakout above it will invalidate today's intraday bearish bias to kickstart a push up towards the upper limit of the medium term sideways range configuration. Next near-term resistance level to watch on an intraday basis after 39,310 will be 39,710 slash 39,830 next. Onward next will be the European stock market using the German 30 as a proxy. So the German 30 or the German DAX rallied as expected and almost hit our second resistance level at 21,960 slash 21,990. So with that, RSI is at the overbought level right now, so there could be a chance of a minor pullback during the start of the European session. Minor pullback, first support level to watch will be 21,820, which is the former minor swing high area of 31st of December and 31st of January, pardon me, that was surpassed yesterday. All right, so what you could see over here is that I will use this former gap resistance here now into a pullback support 21,640, and if you do the Fibo retracement of this ongoing minor steep rally from the low of 4th of February all the way up to today's or yesterday's US session high, that actually correspond to the 50% Fibo retracement. All right, 50% Fibo retracement. So as long as this minor pullback didn't surpass this impending potential minor pullback because of the hourly RSI at the overbought level, didn't surpass below 21,640, we will still maintain that intraday bullish bias on the German 30 after 21,990. The next near-term resistance to watch on the intraday basis will be 21,610, which is the 1.236 Fibo extension level. And if you do the Fibo extension level nearer to the recent rally, which is taking the low of 3rd of February, okay, project it out to the low of 4th of February, that also came close to the 2% Fibo extension level as well. Only an hourly close and a breakdown below 21,640 tighten short-term pivotal support for today, that would invalidate today's intraday bullish bias on the German 30 to kickstart a rather minor corrective decline sequence, exposing the next short-term support level at 21,390. Below it potentially sees 21,110, which is the minor swing low of 27th of Jan and 3rd of February, which correspond to the rising 20-day moving average as well. So that's for the German 30, still maintaining that intraday bullish bias, but in first step, there could be a minor potential pullback first, with the key pivotal support level to watch at will be at 21,640. All right. Onward next will be the major US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So yesterday we do expect a minor pullback to take shape, and the pullback indeed happened and managed to store right exactly at the first support level at 44,670. So still no change, still using 44,250 as my short-term pivotal support level, which is very close to the lower limit of this ongoing minor ascending channel from the low of 13th of January, and also soon to be the 20-day moving average, acting as a next near-term support level at around 44,250 as well. So as long as any minor pullback thereafter didn't surpass below 44,250, we will still maintain that intraday bullish bias on the US Wall Street 30. First resistance to watch will be 45,090 slash 45,100, which is the current all-time high area. A breakout above it potentially sees 45,500 slash 700. Only hourly close and the breakdown below 44,240 will invalidate today's intraday bullish bias on the US Wall Street 30 to kickstart a minor extension of the corrective decline sequence, exposing the next near-term support level at 43,730 slash 43,600. We also come close to the 50-day moving average, acting as a similar support area as well. Okay, so that's for the US Wall Street 30. Onward next with our onward next will be the Nasdaq 100. So no change on the Nasdaq 100 as it continues to shape to actually do a bit of stalling right now at the upper limit of that neutrality zone that we highlighted yesterday, 21,845/945, and upon stalling at the upper limit of the neutrality zone, the hourly RSI now has displayed a bearish divergence. All right, so what you could see is that initially there was a higher high, okay, higher high being stopped, do a bit of pullback, but this pullback is then thereafter the RSI is not shaping higher high, it start to shape a lower high after hitting an overbought level yesterday during the European session. So what it means that momentum has starts to ease off yesterday, indicating lackluster positive momentum. This give us another, we call it a element to be not so be outright bullish on the Nasdaq 100 for today. So for that, still maintaining that intraday neutrality stance for today on the Nasdaq 100. So remain neutral between 21,845/95, and the lower limit will be at 21,570 for today. So that's for the Nasdaq 100, still maintaining its our neutrality stance. Given number one, we start to see lackluster elements depicting a lack of bullish momentum as depicted by this bearish condition that's being displayed right now on the hourly RSI. So with that, that sum up the intraday technical outlook on the major stock indices. So next cross asset classes up next will be the commodities market, starting with gold XAU/USD. So for gold XAU/USD, it actually bang on. Initially, we also we expect a minor pullback right below the 28,890. The minor pullback take shape, a bit of a whipsaw right exactly at the first, right below the first support level of 28.45, and but it didn't surpass below 28.30, and in fact it did a minor bullish reversal right exactly above 28.30, which is our short-term pivotal support that we highlighted yesterday to maintain our bullish bias for gold XAU/USD. So for sure 28.30 is indeed a clear short-term pivotal support level for gold XAU/USD. So for today, we'll still maintain that intraday bullish bias. We do not want to tighten it to be so tight because it hasn't surpassed above 28,890. So 28,890 will still be our first resistance level to watch for today. Above it may expose the next near-term resistance level, which is defined by a Fibo extension cluster level, 2,909/2,912. Only a surprising hourly break and an hourly push down, hourly break with hourly close below 2,830 short-term pivotal support that would invalidate today's intraday bullish bias on gold XAU/USD to kickstart a much more deeper minor corrective sequence within its medium-term and uptrend phase, exposing the next near-term support level at 2,812, followed by 2,795, which is also correspond to the lower limit of this minor ascending channel that I drew from the low of 31st of December. All right, so i.e. no change, still maintaining a bullish bias for today for gold XAU/USD using the very key short-term pivotal support level at 2,830. All right, so lastly will be the West Texas crude oil. So the West Texas crude oil plummeted as expected and hit our first support level at 71.05, where we have a bearish bias for yesterday, and it didn't break below 71.05 right now. And what you could see over here is that it may start to shape a bounce. So first resistance level to watch 71.85. Second resistance will be the short-term pivotal resistance level that we highlighted yesterday. We also confluence with the 50-day moving average acting as the resistance level as well, 72.70. So as long as this bounce didn't surpass above 72.70 short-term pivotal resistance level on West Texas oil, will still remain that intraday bearish bias thereafter for West Texas oil after this potential bounce take shape. A breakdown below 71.05 may expose the next near-term support coming in at 69.80, which correspond to the lower limit of this minor descending channel that I drew from the high of 16th of Jan, and as well as the minor swing low area of 27th of December. So i.e. there could be a bounce taking shape as long as this minor bounce didn't surpass above 72.70 short-term pivotal resistance level. The potential bearish bias may still hold on the intraday basis thereafter for West Texas crude oil. All right, so that sum up the intraday technical outlook on the various key cross asset classes. So before we go, let's take a look at the calendar. What are the key data to look out for other than the non-farm payroll data that's going to be out later during the US session? So right now during the European session, data that could impact the euro currency and the German 30 or the German DAX will be at 3 p.m. The balance of trade figure for Germany, being anchor economy of the Eurozone, followed by industrial production as well for the month of December. Then thereafter, we do have one ECB official speaking, 4:45 p.m. ECB Gundos, she will be speaking. Then thereafter, we do have BOE Phil, another official that is speaking at 8:15 p.m. after yesterday's movement of the sterling dollar. Interestingly, this speech by BOE Phil may cause movement on the sterling dollar potentially. That will be at 8:15 p.m. Singapore time. And for sure, for those who are interested in the Canada dollar or the Canada crosses, at 9:30 p.m. Singapore time, we have Canada labor data. And also at the same time, we have the all important non-farm payroll data. So this non-farm payroll data out at 9 p.m., 9:30 p.m. The consensus is a very low ball figure of 170K. So previously market is at 200. Previous print for the month of December was 256K. So with a low ball 170K figure, that could easily be beat on the upside. So if that happen, potentially what we could see over here, it may cause a bit of two-way volatility in the FX market. All right, and also another number to watch will be the unemployment rate. So unemployment rate will remain stable. Market is expecting it to be at 4.1%. Then thereafter, you have the Michigan consumer sentiment. So this is a flash figure, a preliminary figure for the month of February. That will be out at 11 p.m. Singapore time today. Market is expecting almost the same figure as the previous month of 71.1. All right, so something to take note of as well. And also within this preliminary consumer sentiment, they also have the 5-year inflation expectation as well, and as well as the 1-year inflation expectation. Both of these results are survey based result, so something to take note of. So if the inflation expectation, both the 5-year and the 1-year survey result continues to tick higher, that could actually mean that inflationary pressure could come into the US in the near future, which is in line with our inflation expectation that I shared with you all using the 5-year break even and the 10-year break even earlier this week. So that could mean that the Fed will be likely to be much more less dovish for 2025. All right, so that sum up the today's daily dose of market insights. So I wish you guys a happy Friday. Have a great weekend and still enjoying the ongoing Chinese New Year celebration for those who are still celebrating. And we shall speak again on next Monday. Thank you.